Hi, everybody. Good afternoon. So I've met some of you, familiar faces. Nice to be meeting you again. So on today's session, I'm very happy to introduce Emmanuel Murray, who is with Caspian Caspian Investment. He's a director and has been closely associated with Will Grow for many years now. He supports the development of food in the agricultural ecosystem and has been a great resource for us as well to guide us down the path of rural financing and micro entrepreneurship. Sorry, that's much entrepreneurship financing. He's very adept with his 42 years of experience. He's been very adept at navigating emerging businesses, complex, often unstructured market environments. And in today's session, he's going to give us a perspective of how to lead the funding conversations with potential investors, how to look at various capital structures based on which state of growth you are in as a founder, and provide you with insights on how to actually pitch for funding and what kind of funding to pitch for. So very happy to be here with seeing you, all of you once again, and very happy and honored to have Emmanuel Murray with us leading the session.
Right. So Emmanuel sir, we'll just hand it over to you. I will present screen to share the slides. And everyone, as always, we'll be keeping an eye on the chat box and raised hands. So wherever you would want to come in, please do feel free to use those options. So,
Yeah, we can move to the presentation right away.
yeah. Please
Yeah.
let me know if my screen is visible.
Right. So yeah,
Yes.
it is. So thank you, WRI and Will Grow for giving me this opportunity to speak to all of you. It's a small group, so it's going to be a pretty informal conversation rather than some very big yarn being transferred through this time that we're going to be together. It's largely based on experience over the last few years working with Caspian, both on the equity and the debt side, and the work we've done also with mentoring early stage businesses. So that's going to be the basis of this talk. And as always, this is based on experience, so it can't be taken as the final word on anything. And with that introduction, let's start with the first slide, please. Okay, so restoration projects, have this problem of what is called externalities. That is, the benefits accrue not only to those who are the target of the project, beyond that also, and therefore the value accretion, trying to capture that for an investor becomes very difficult. Let me give one example. In watershed projects that we worked on, many of them at NABARD, we did a large number of watershed projects. And we invest heavily, almost 1 crore per project, working in the upstream and in government lands, in the hilly terrain, in the upstream farmlands. And then we ask all of them to work, contribute, their fertile land for the drainage line, do bunding, and ultimately the beneficiaries are largely in the downstream, who may not really have the need to do too much of work on their lands. But all that we do in the upstream benefits maybe the large farmers in the downstream, and then we can't capture that, or we can't uh, get them to contribute to the part of the project. And similar is the case with most other projects, like a bridge project that we funded. You can always have a toll on a bridge, but in a particular place closer to Vishakhapatnam, where a bridge collapsed and we built another, the land values in that area boomed after the bridge was constructed. But then, how do we monetize that. Would a toll be able to capture that? That's not the thing. So that is a universal project with most of these kind of projects where restoration is involved, the larger externalities. And that is why either government has to do this kind of projects, or if commercial capital is there, there has to be some mechanism to be able to recover the costs from those who benefit from it. And since this is quite difficult in many cases, these are left to uh, people like NGOs and others to do it, or some grants and that kind, but not commercial capital. Next slide, please. Okay, so funding pathways. Let me again thank the Wilcro and WRI team. They gave me a good outline of what to cover, and I just faithfully followed that. So, grants is something all of you are familiar with, and I wouldn't like to spend too much time on that, but they're very important for the initial phases of doing your business. And I have been part of, in the last few years, part of incubators and accelerators that give out grants, and I can kind of vouch that there is a reasonable degree of objectivity and evaluation that goes into the selection process. So while I was outside, I would always think that there's some nepotism, or there's already fixed, this grant giving is fixed. But as I saw, there are, as of now, decent processes and merits and evaluation done because of, again, things like RTI and people asking for minutes of meetings, even video recordings of the meeting. So there is good amount of objectivity in the selection of the grantees. And prize money, of course, many of you have been competing in different events and winning prize money. And that is the second funding source in the early stages of business for most startups. Paid pilots are the third way that many of these early stage projects take off. There are institutions like Social Alpha and others who encourage technologies that are relevant to the country but are too early to be funded commercially. And then they provide scalable opportunities through paid pilots. Next to that, of course, comes equity, which is what we have been talking about. There's an overemphasis really on the whole concept of equity. It is seen as if it is the ultimate uh, that everyone has to aim for, not necessarily correct. And then most investment in that stage happens in the form of convertibles. Now, why these happen in the form of convertibles is because valuing a company at an early stage, valuing a business at a very early stage is a very complex process. The entrepreneur thinks it's a diamond, and we think it's nothing. It's dust. So there's no meeting point in trying to decide on what is the value of the company. So we say, okay, we'll give it in a form that we'll discover the price of the company later on when it grows to a scale. Convertible also gives an opportunity to exit the business if things go wrong. So there could be partially convertible instruments where the investor doesn't see things happening the way they want it, then they could always exit using a convertible structure. And finally, debt is the way. So if we look at how many in the agri space, at least 160 odd companies have been equity funded by VCs, but multiple of that, 5 times of that have been funded by debt. So debt is something which is more potentially accessible rather than equity. And then I in my slide, Ananya's running the slideshow, but I wanted to add it in. The thing that we forget is paying customers. Paying customers are really the actual guys who fund your business, more important than all the others. So if you have paying customers, you really cracked the business and you're on your way to success. Next slide, please. Okay, so in early stage investors, we could classify all of them as angel investors. So that's just a common terminology. There is no angel-like qualities in these guys, but they're called angel investors. And they invest in the business at a time when there's a lot of unknowns, and they still believe. So they bet on you as an entrepreneur, the bet on the technology as a kind of a breakthrough solution, and the market as being large enough to absorb this or to an opportunity for giving them the potentially scale for the business. So angel investors come in very early. People like us want many more things to be clear and known before you invest, but they take bets without everything being disclosed or known. And who are these angel investors? Largely high net worth individuals. This term HNIs was not defined till recently, but SEBI has now said that those who have 5 crore and above in financial assets, only those are HNIs, and those with less than that, according to them, these are risky spaces, and people with less than that kind of asset should not be encouraged to be investing in this space. Family offices, again, many of the HNIs have set up family offices and leave it to professionals to run their investment portfolios. They don't do the day-to-day decision. The final call is with them, but they leave it to professionals to run. Startup founders, especially those who have partially exited or who have made some money out of business also, find this space exciting and love to invest into new businesses. Then startups themselves have investment investment objectives like Samonati or Ninja Card. All these companies have a kind of a strategy to invest into businesses at an early stage, those which are related to what they do, or where they believe there's a potential upside that is possible and that they understand those businesses. So startups themselves have also been making investments into early stage. Yeah, next, please. Yeah, institutional funding and why again, we have these blinkers that funding means VC funding, and which is really a little bit of misleading and the wrong way of looking at it. And to call guys like us investors also is a misnomer. Basically, we are fund managers. We are not investing our own money into the business. So we are managing, raising funds from others and then deploying it. So we ourselves are only fund managers. And why institutional funding? For example, in the kind of cohort that we have here, VCs may not be the appropriate people to approach. It's because of the reasons given here in this slide. Today, the 10 years ago when we started looking at agri businesses, a crore used to be a decent sum for a first round of investment. But today, everyone talks about $1 million. So anything less than that, they call them micro VCs. The VCs also look at others who are investing less than that as pariahs, and people calling them micro VCs. So ticket sizes have grown. Slower pace of growth again. Many of the businesses like the ones you are into, we cannot accelerate the growth into some 2x or 3x or 4x in 5 years kind of models. And that is where the kind of VC money comes. Government again has promoted a lot of fund of funds. SIDB, NABARD, all these guys have promoted a fund of funds and they invest into funds of, let us say, Omnivore, Encore, and others. They invest into those funds. The reason why they do this is a government organization uh, cannot understand losses. If you have a fund, there's likely to be some write-offs required. Some of the investment will go for a toss. But if it requires to, go through a CAG audit and other things, it's very difficult to explain why they didn't work. There will be questions about fixing responsibility and all those. So the shortcut to that is to give it away to another fund, and assuming that on an averaging basis, at least on an average, capital will not be lost. Returns may be low, but capital won't be lost. Now, by doing that, what has happened is the really relevant investments for the country or for the sector are forgotten because these funds go on a commercial motive. So although they've been given a mandate by the government to look at businesses that are relevant for the country, that require to be supported, this is all forgotten when the VC invests. Performance of past investments, again, it's quite obvious that especially this space hasn't performed great so far in terms of both returns and exits. Both of these are yet to be seen as cited in a significant scale. And a longer time frame, again, land-based projects, in our view, we have been in that space from NABARD side for 20, 30 years. So it takes 15 years plus land restoration projects or plantation projects, forestry projects. So a typical investment is raised for a 7 or a 8 year horizon, at best a 10 years. So they don't match. So these are not suitable for VC kind of investment. And then the assessment tools, interestingly, many of the folks who have met these VC say this, the same guys ask the same questions over and over again, whether it's the analyst or the partner, is the same set of questions that they keep asking. They don't understand unconventional businesses. Yeah, next. Okay, so in this space again, some of the guys who've done significant investments, I put those numbers there, got some data from them. And some of these, like Indigram is on their website, the data is available. The others I just obtained from them. And so, so the two, both Indigram and IMA Ventures have been the most successful in investing in this space and also getting exits. And AID, of course, has made a few, one or two exits, but is struggling to do. The whole idea of, the funders to these incubators, this money is all the money of the government or donors or somebody who's given them money to these institutions saying you invest. And the idea was to make these institutions sustainable through upsides from exits, which have not happened in a very large scale, except Indigram, which has made quite a bit of killing out of the exits that they made. Although the data I don't have, but these are some institutions who have really promoted early stage businesses in this space, in the agri, land, climate space. Okay. Next one, please. Okay, so impact investors again. This was one question that was in the outline that was given to me. Who are impact investors and how are they different from others? I think the core of an impact investor like us is it's at the entry stage, it is a selection criteria. So if we don't see impact in a project, we reject it. But then we do not try and evaluate the extent of impact, quantify impact. All those we believe are very abstract, very expensive to capture. But overall, if the business seems to be doing something good, education, healthcare, or something, then it is acceptable to us, and that is how we go about it. So we focus on sectors which others may not seriously look at for reasons that these are difficult. Something like water may be difficult for others to look at, and we invest time and develop a lot of knowledge in that. And any investment that is made by us, we actively manage it. One of the criteria for saying somebody actively manages is, are they on the board of the company? Are they really participating in decision making? So we do that as active investors, and we help with convergence rather than just looking at returns. So these broadly, I think there are 5 to 6 in India impact investors, so seriously impact investors. Yeah. Okay, next slide. Okay, so what do investors look for? So, investors put money down not because they love you or they want to help change the world for the better. They're basically there to make some money out of the investments they make. And so they look at any business and see, can that money that the business makes be monetized? And can we get a share of the benefits that accrue to it? And in due time can exit. So there is no investor who makes a permanent investment into any business. So exit in the investment memorandum that we prepare for the committee to decide, we have to write a paragraph or two about what are the options for exit when it is due for exit. So it's essential. If there's something where the potential for exit doesn't exist, then it becomes very difficult for us to make it a case for investment. And what investors look for are the market. So pilots are good. Small projects may be doing great, but unless there's a potential to grow that business, it will not be a very attractive candidate for investment. Okay, next. Okay, so the impact is the factor that we look for in these things. So in different ways, let's say we were looking at a investment which came for building some resort, a weekend resort for people to come and stay. So then does that give an impact? Or, so you can try and indirectly impute, it creates employment for local people or things like that. So really we have to try and justify impact in everything that we do. And we actually look at the other extreme of do no harm, even if it's not impacting positively or it's difficult to capture that it is not doing any harm. So maybe nuclear weapons or something, maybe the thing we don't invest in, but otherwise anything else we see as positive and potentially having impact. And how we identify the impact that the project makes is for the one who's evaluating it to try and assess. Yeah, next please. Okay, so these are what we look for primarily. So typically, the pitch deck or the financial statements, and all these are there for anyone to evaluate. But while evaluating a project, we look at other criteria beyond just the ones which an AI or somebody, a tool, a bot can evaluate. So the qualitative aspects are what we try and evaluate. Preferably, we like a team which is more than one person, so that they bring in complementary skills. So if one guy is an operations person, another is a marketing, or fundraising is something which I think no startup can avoid. Uniqueness of the solution, basically that it cannot be so easily copied. Otherwise, you will be left with nothing if somebody else does something similar to you. Regulatory landscape, really very important, especially in these areas like electric vehicles or solar pumps. These are all propped up by huge government grants. If those are removed, then does the business still stand? This is a question we have to ask. Competition and paying customers. Competition, basically because a competitor with deep pockets, with a big time investor, can kill you even though your technology is better. So we need to see who are the competition, and how confident are we to face the competition, and ultimately paying customers. All these, if you see in a lighter vein, startups who are busy chasing competitions and prize money rarely become scalable businesses. These two are mutually exclusive, looks like. So unless there is commercial business, at least 50% of revenue is coming from paying customers, we feel the business still hasn't reached a scale where it is investable. Okay, next. Okay, so there was a question about red flags. Uh, so what happens again? People like us, when we do the due diligence, we go in teams of 2 or 3, and then engage in informal conversations. You can always sit down in the office and get the team to furnish you the information, but there's always things that you can get to know about the person only in an informal setting. So you take him out for dinner, have a conversation, then you get to know the personality more than through just meetings. And that some of the points from our experience is people who are so possessive about their businesses, who want to know everything and want to do everything themselves. It constrains growth, first thing. If you want to be in control of everything, then there's limitation of growth. Second, it doesn't attract talent. However good you may be, at some point you need professionals to run your business. And if you're not the type who's going to give away some of the control, no professional would be happy working with you. So if those are some qualities, and these are inherent qualities, difficult for a person to change later in life. So a data mess is a very common thing. We ask for data, they furnish some data. We ask for clarification, they furnish a new set of data. Sometimes there's another data set of data which doesn't match with this. So data in most early stage businesses is neither captured properly nor analyzed nor compiled. So if that can be done, if we ask for some information in the morning and by evening it's with us and there's consistency in data, it ticks many boxes. We feel confident to proceed with looking at it a little closer. Otherwise, if that is not done, then it raises a great deal of suspicion. Then we go back to, let us say, IT returns, GST returns, trying to reconcile whether the numbers they've given match with those numbers, and then validate whether we are looking at the wrong institution in the first place. Governance issues, as it says, family members as directors, as employees, uh, serious governance issues in many companies. Single founder or too many founders. The life is so uncertain these days. So we can't risk having a single founder. We don't know. We do ask questions about their health status and other things, but we don't probe beyond that. But we like if there are more than one founders, and if there are too many founders, we've seen that conflicts arise. More than 4 founders, rest assured, in 2 years there'll be conflicts, and then you will be as a shareholder trying to buy peace and negotiate between these guys. If the ownership is significantly diluted at the time that you are entering into the business, the skin in the game of the founder is not there. So he also will lose interest. He has nothing to lose. So if his stake by the time you're doing the early stage investment is less than 75%, we believe it's not worth investing in. It's just a belief that we have, because every time a further raise of funds is there, there'll be further dilution. So ownership, the upsides and the gains of business have to come to the promoter. If it has to come, then he or she should own a major stake in the business. Unwillingness to listen and be guided. I don't need to say much about that. The frugal mentality is another thing, especially professionals are expensive these days. And some of these guys are not willing to pay market rates and run it with, you don't have a CA, you get an accountant to do your business. You compromise on quality, especially of manpower, and then we don't find it worth looking at people who are looking to cut corners on that. And then, of course, living in a fantasy world, exaggerating, their potential, what they're doing, dream world. Many guys are like that. They think that they're doing something fantastic, and then they are living beyond reality. Yeah, some of these are the risks that we look at, and most often, I think, if we see 2 or 3 of these red flags, then we step out. We don't go further into these businesses. Yeah. Next. Okay, so these are what we really admire in entrepreneurs. So a depth of knowledge rarely found actually. There may not be great depth, but at least clarity about the subject. Many of them have come from software or some other line into something else, into land development or into forestry, but have they picked up the knowledge adequately, or is it superficial, just taking a pot shot at something which they are not very clear about? Passion and stamina again. These are important things, qualitative aspects, difficult to evaluate, require us to. That's why, when we come in and talk, one of us leads the conversation and the other makes notes or observes, not even makes written notes, but observes the persons. And then we exchange notes afterwards about how the conversations went. And that is why we try and capture qualitative aspects about the entrepreneurs. And we believe that most of these agri and other startups, the founders need to be out in the field for at least 10 to 15 days a month. So if they are not, then they're building only solutions in isolation in some air-conditioned cabins. So it's important for us to know that. And balancing the social and business motive. Again, if somebody is too passionate about, then they have a what is called NGO mindset, and they may not be able to do a business. Not bad, but not investable. Okay. Yeah. Okay, so from your point of view, let's look at some things. Timing. If you raise funds very early, you will not get a great valuation. And then you would dilute too much too soon. But if you don't do it in time, then you will reach a situation where you're desperately looking for money. And at which time you will compromise on the terms and conditions and give away more than you should. So, what's the ideal time to do it? It's easy to say this, but it's for you to decide. Not too early, not too late. Okay. Inconsistent information, we already talked about. Hiding facts. Very, very often we find lots of things undisclosed during the course of this, including, many times we find, let's say, educational loans not repaid by the promoters. So these are things we find as ethical issues. He may or she may not have paid up the loan, but it's important to us that this is a fact that we know before we take a step into the company. Okay, and saying no to a great opportunity. Again, I think sometimes founders want some valuation which is uh, absurd, which is beyond imagination, and then they say no to somebody who came, and unfortunately, you don't get a second chance. That investor would have moved on and not come back to look at you. Not engaging professionals to deal with investors. I think investors sit on a lot of money. They have the capacity to engage the best CAs and the best lawyers. And you, as a startup, may not have that much of the ability. And therefore, this becomes a one sided transaction. Unless you invest into this, you will too late in life realize that you've made some mistakes in compromising on certain terms and conditions. Yeah. Okay. Okay, so from a Caspian experience, what we see is some of these, again, I won't go into each case, but a lot of, the pitch decks or the 5 minute pitches are full of information that has to be validated line by line. A lot of things that are claimed are really not really the truth. And therefore, we do not generally go back to the pitch deck, but if we do, then we carefully scrutinize those. And not to panic when things don't go as per plan. We just mentioned a company called Balwan Krishi. We were going in with another investor, and suddenly in the last stages, that investor dropped out and said we are not going to invest. So we didn't panic. You suddenly worry. Does that investor know more, has more information than you about the company? What's the rationale? Why they're stepping out? But our ability to objectively evaluate without being guided by somebody else's opinion, something. Missed opportunities again. Typically, these startups, they'll get one term sheet from you and take it to another investor and try to get a better deal from them. And then those are the kinds of missed opportunities that could be there. It really doesn't matter, but sometimes you regret that you didn't match the terms or didn't give a valuation and missed a good business opportunities. And then, of course, the debt company. We were fortunate to have both a debt company and a equity investment firm. So our evaluation methods are the best of both. Therefore, many times we were able to see businesses that were great, promoters that were good, but VCs bypassed them and they became good cases for us for debt financing. And crossing the risk threshold again, there will be the simple hypothesis for an NBFC is that if everything was great with that company, SBI would have lent to them. So there's something that is deficient or inadequate, and that's why they're coming to you to borrow at a higher cost. So what are those deficiencies, acceptable deficiencies, which we can go with? That's the thing we have to look at when we look at this risk threshold. And we have our own criteria about this, so maybe simple things like, let's say, paying PF, depositing PF deducted by the employees has not been done by the company. How do you see that? Is it something deliberately done, or is it? So things like that. There would be many shortcomings. We see something like, let's say, maternity leave not being a policy in the company. Then we try and get these rectified. If everything else is good, we say, if you can set these in order and come back, then we'll have another look at you. Okay, and then of course the David and Goliath story, where large investors have put huge amounts of money into companies who are doing burning cash and growing. Can we invest in another company in one small way and then survive and grow our business? So Flixdrop is one, of course, which we have invested. No, it's too early to say we've succeeded, but we've been competing with the companies of the size of Stella Apps and others who are maybe 300 times as big as this company and still be able to make a mark, right? So in all these, intuition and instinct play a great value. So it's not only the numbers that help you decide, but you also have a gut feel about what you think is an investable business. And that gives you a possibility. If you invest into one company with some solution, you can't create competition for yourself. You can't cut your legs by investing into another company doing similar stuff. But in debt, we can, if we mastered the knowledge of a business, we can fund 100 companies doing the same thing. So that is the advantage of being a debt company. So once we know a business well, we are able to do 10 transactions with similar companies very quickly. Yeah, right. Next, please. Okay, so evaluating term sheets. I have been part of 4 investments so far personally on the equity side, but I have not been part of conversations on this side. Uh, very, what do you say? Uh, uh, Tough conversations that happen. We usually leave it to our lawyers or people to negotiate these terms, and I have not fully been part of it. But I can tell you, unless a startup engages high quality professionals, it would be a one-sided transaction. That much I can tell you. You know, the fine print would be so much in favor of the investors that if things go bad, you will realize that you won't even have a rupee to take out, and the investor will take whatever is left in the company. Yeah. Okay. So we were talking about debt as an option. Many startups, they say, okay, equity you're not able to give. Why don't you give us debt? It's not an easy story as that. Debt can kill you unless you're a real successful business. So taking debt just because you didn't get equity is no argument. And when there is a demand, where there's a latent demand for your product or service which you cannot serve because of capital crunch, then debt can play a role. You need to have adequate margins in the business to service. And the third is the cash flow. So sales is not the end of the business. Collections is. So many businesses again sell to the government. The government never pays them on time. And lenders like us sit on their head and file for liquidation of the company. So unless you're sure about cash flows, don't go for debt. Yeah. Okay. Okay. So again, taking debt and growing is a great way because debt brings a lot of discipline to the business. So by force, you have to make reports, you have to repay money on time, and we have seen many cases. We've seen a lot of our equity investments have happened from our debt portfolio. After we studied 1 or 2 years, we partnered with these. We know their businesses inside out, and we say these are intrinsically valuable companies, and then we invest into them. So debt is one way to grow, and then you will become valuable. And many cases, not us, but even other investors have invested into companies where Caspian has put debt. That's the kind of reputation we had as lenders. Yeah. Okay. Okay. So we get into this whole concept of blended finance. Blended finance is basically taking philanthropic money or uh, grants and then pulling it along with commercial capital so that these can be invested into companies which are otherwise, let's say, cash starving or high risk. So they're not getting funding or they're high risk projects. So we can de-risk these businesses and inject capital into them and speed up the pace of growth. Basically, we can accelerate the growth of businesses through blended finance. Yeah. Next, please. Okay, so like blended finance was more a theory till some years ago, till we, the Will Grow team and us worked together to build it from ground up. From an idea, we built the concept, then Will Grow went out and found some funders, and then we got ready, and then ourselves also did some debt funding as well as over the course of time, others also uh, became lenders to companies through this kind of a model of blended finance. And this is thanks to Grow that uh, the grant money could be multiplied 3x to 5x times. And fortunately for us, most of the money came back without being lost. So we have been able to redeploy and recirculate that money. So it's not 3x, it may be now 20x. The grant and the money from the philanthropy has been multiplied many times over the years. Okay. 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 So one of the mechanisms of blended finance is called first law default guarantee. So if a loss occurs, the simple thing is if the loss occurs in a business, the first 20% or the first 25% of the loss is absorbed through this kind of a mechanism where some money is kept aside as a deposit with a charge over it, or as a floating charge over the money that is there, and in that way we have utilized it. It could be a project to project. Again, FLDG could be a project to project basis, or it can be on a portfolio basis also. The whole logic of FLDG is to not compromise on due diligence. Just because you have a guarantee, we don't dilute evaluation processes. It's just that the business may not have the kind of money, or it doesn't have the vintage, or reasons why it hasn't been able to attract the capital it requires. But if there are deficiencies in the processes of business, or if there's some high risks, we don't get into that. So FLDG is not a way of getting into territories which are unknown, risky, unevaluated. Yeah. Okay, so the last, of course, will grow as enabled debt to 19 startups across multiple sectors through this kind of a mechanism. The next one, please. Okay. Okay, this is the portfolio of blended finance of Will Grow, which is up there. Their own companies, not their companies, also affiliate cohort. So the idea of doing this blended finance was to demonstrate to the whole sector about the potential for doing blended finance, not that we should do everything ourselves, and that this could become something that could be picked up and done by others as well. So that is the reason why we did this. Considerable, I think, a majority of these companies have done well. Yeah, like Bharat Rohan or Pasadi Panta. Some of these have scaled up significantly. The whole idea was that blended finance should be given once or at best twice. By the third round of funding, it should not be the basis for lending to the same company. Yeah. Okay. Next one, please. Next slide.
Yeah, so I've changed it. Is it reflecting?
It has now come. Yeah. So these are some of the partners which have participated in the Wellgrow's blended finance program. There was, of course, SBI Foundation and FWWB also, I think, who are not mentioned here, but they were also. SBI is there on top. SBIF. FWWB also, I think, did one or two transactions in debt along with Willgrow and yeah. Okay. Next, please. Yeah, it has not
I think
changed.
there's a little bit of a lag.
No problem. We'll wait. There's no rush.
Let
There's plenty
me
of
know if
time.
it's reflecting.
Okay. Okay.
Otherwise, I'll just read. Okay, is it showing now?
Yeah. So looking at the companies, did we miss one slide? Can you just go back, please?
So I think the earlier slide was on the fundraising data for this cohort, but I think some of it may not be publicly available. So since the entire cohort is here,
okay. You don't
think
disclose
we may
it.
not be able
Okay.
to discuss it. Because the document was internal. Yeah.
The idea really was that some of you have raised considerable amount of funds. So the gyan of how you did raise funds is something you can learn from each other, not just from me, because I have never raised funds as a startup. These are just learnings and observations that I'm sharing with you. In the space that you people are operating, I just wanted to tell you about trends. For example, Shrestha, which is also known as 24-letter mantra of the brand, uh, struggled for many years to raise funds and finally was bought out by ITC. And then there's Two Brothers, another company which is raised considerable money, but which is more through PR kind of thing, which not every one of you can do it. So trying to build a reputation through great visibility and storytelling. In farm machinery, again, some of these companies, the early companies like Kedo, EM3, that is not forward, failed. And therefore, farm machinery never has been a great attraction for investors till date. AgroSure recently raised about 1 crore of rupees from Social Alpha. Balwan Krishi is our investee company, but it's more into trading rather than manufacturing machinery. So, machinery. Soil testing again has seen considerable interest. There are companies like Krishi Tantra who raised good amounts of money. Then there are companies like Soil Sense who have not been able to raise money. And there's Scanext in between who has done something. So broadly in soil testing, there are two types: wet and other one through spectrometry. There are broadly two technologies that are there, but some funded, some not yet funded, some inexpensive, some expensive. Climate is another space where there are lots and lots and lots of companies and a lot of investors as well. But our own understanding is that there's still time for this industry to evolve and a lot more of clarity needs to come. So the broadly two types of companies in this space: one who sell the credits, who are the traders, and they rely on those on the ground who actually generate the credits. And the connect between these two is a pretty weak connect. So what our learning has been that the guys who do the marketing of credits do not even know where the projects are being implemented on the ground. But there is a lot to be done in this space before we really get more clarity about this. Yeah. Okay. Yeah. Okay. So this may be my last slide, and there's a general feeling that funding is the most important thing for a startup and could make or break its business, which is not really the case. Many times startups fail because of reasons that are put up there, especially very tough spaces like agriculture, where it takes years and years of hard work to get any results, and the founders generally run out of steam and give up. Failed market traction. Many we see who have failed because they have not been able to really get into the commercial side of business. Technology is evolving at a pace like never before. And unless every startup is continuously updating their technology, they could be left behind. Founder disputes, very relevant, although they may not be highlighted in the public or in the press. Very commonplace to find these disputes. Frauds, there are some at least which are public, and there are others which are not, but could be reasons why businesses fail, because most frauds mean you siphon off money, and when money goes out of business, it dries up. Okay? And then reckless cash burn. So the last one is the story of the last decade. You burn cash to grow on the assumption that you can raise money again, somebody will put more money into you. And if that assumption doesn't come to place, you are done. So this cash burn model has been a commonplace model among the large startups for the last decade, and has been the reason why many of them have failed. Yeah. So this is, I think, all that I had to say, and we're done in an hour. And the rest of the time is yours to ask questions. Yeah.
Thank you so much, Mr. Murray. This was truly a really wonderful session, and we're glad that we've covered everything that was planned for it. We do have some questions in the chat box. I'm just going to read through them and also.
Shall we start with the questions in that note that you shared, and then to the chat box?
Sure, sounds good.
Yeah.
So I'll just read out some questions that we had from the note that the cohort members had shared with us before the session. One was from Mahesh from Agribusiness, and I would request that you can just step in, Mahesh, as well, wherever you want to clarify the point. So the question was, while scaling a model, what points should be covered? And I'm sure some of these questions have already been addressed in the session itself. So Mahesh, do you want to come in? Are there any points outside of the session, any specific questions that you have or pointers that weren't covered in Mr. Murray's session that you want to bring up?
Yeah, Mahesh, are you there?
Yeah, Mahesh is there. Mahesh, can you hear us?
Okay, so without wasting time, there are two things I can say, that scaling up has to be when your unit economics works. If you're scaling up in a manner that for every unit of product or service that you're giving, you're losing money, that is no scaling up. The second scaling up that we don't even take into reckoning is scaling up by trading. You know, you just buy and sell something and you just increase your top line. And this has been one great way of doing it. You get some trader to raise invoices on you, and you round trip transactions through your company, and then grow the top line just to show some imaginary valuation. So those are not ways to grow. Your growth has to be real. So scaling up in a realistic manner with making money out of every unit of product or service. The second thing about scaling up is, when companies are small, you as the promoter have control on everything.
I'm sorry, I think you went on mute, sir.
Sorry for that. So the second thing about scaling is to have systems and processes and controls in place where your physical presence is not there and still the business is running on principles and rules. There are companies, I'll tell you, like our food, who collapsed because there were no systems and processes. So you grow too fast, you put people there, you have no control, there's no reporting system, there's no MIS. By the time you wake up, it's all gone. Okay. So systems, procedures, controls are important as you grow.
Got it. Thank you, sir. I hope that's answered your question, Mahesh. Moving forward, we have one question from Oscillo Machines from Prajwal. At our current stage, and you might want to elaborate here, Prajwal, at our current stage, what milestones would make us truly investment ready? Mr. Murray did have a chance to go through the cohort deck, but if there's any specific question that you have with regard to your stage, or to add on any specific questions that you have, this is the right time to do so. Over to you, Prajwal.
I think I just wanted to, we are speaking with few investors as well. So after the few meets, the answer remains the same. Like we are concentrating on the SaaS product, so not a hardware, or agriculture may not be a domain.
Correct.
Yeah.
So growth, will be slow in products like yours. So if you can demonstrate a good order book, that would be one good evidence that you are investable. The second, I think, is the distribution. So if you have a distribution network to sell your product. Third would be competitive pricing. So how do you compare with others? So in these kind of businesses, unfortunately, in a global world, China or somebody else has the same product at a competitive price. So it becomes difficult. If they peg and the restrictions on import are very limited. So companies like yours, I think the comparable company like yours in this space we see is AgroSure, where Social Alpha has recently invested about 95 lakhs as equity. So probably you also generate volumes, have an order book, have distribution. So it's not that you pack each product and you ship it. You should offload your distribution to professionals who do that work, and you concentrate on production. And then there should be, and as we were discussing all through, investment or investor is not the object. If you can grow with debt and if you can grow as a bootstrap company and still be happy, there's nothing like it.
Yeah, thank you, Mr. Murray. From Kedut, we have a question from Namrata. Manish, I've noted your hand. You can keep it up and I'll come to you later. So from Namrata, who's the founder for Kedut Samriddhi, the context is that they started off with the idea of helping farmers, having very little knowledge of the investment or even the business ecosystem. As a result, after receiving a seed funding of 5 lakhs, they did not raise any capital, also being busy with operational challenges they faced in 2020, 2021. They also stopped seeking investments, although they did receive a grant fellowship 3 years back. So the question that they have is that they've been managing without investments or grants for the past 3 years. They made a revenue of about 33 lakhs last year and achieved break even last year. So in order to grow now, they will need investments or a change in strategy. Can their business attract investments at this stage? And if yes, what are the things that need to be in place for it? I think Mr. Murray did answer a part of that question right now just in his response. But yes, if you want to add on to that, Mr. Murray.
Oh yeah, so you need to work out your business plan and decide how big you want to be, right? To what scale you want to reach, and then decide if you want to reach that scale, how much money do you need? And then once you come to that number, what kind of money do you need? Should it be debt or should it be grant or should it be equity? So you need to figure those numbers out. The kind of business you are in, except for certain biologicals and other kinds of companies, the others in this space haven't attracted too much of equity capital. So is there an IP around what you do? Is it something very unique that you're doing? Otherwise, because equity investors are looking, as we discussed, for both returns as well as exit. These are the two criteria. So you can yourself, do a self-test and say, can my business give a return of 15% plus? That is a threshold rate you can mark. Does your business give a return of 15% plus? Can an investor who invests in you get an exit in 5 years? If you can answer those two questions, you can go for investment.
Thank you.
Thanks, Namrata. Hope that addressed your query. So we can have another question from Nature Connect India, wherein Mr. Jayant has asked that what would you consider as critical factors of success for restoration-linked value chains? And he's given an example of jackfruit seed powder in absence of offtake agreements. We have Mr. Jayant on call with us as well. Jayant, if you want to add on to this question, and yeah, over to you, Mr. Murray.
No. This is pretty much the question I had in mind.
Can you articulate your question? Because I think we must remember I am not an encyclopedia. So I may not have all the answers.
I can
take
simplify
all
the
questions.
question. I can simplify the question. Basically, if you have a very innovative product, a new product, where its impact on environment is very good. For example, the jackfruit seed powder is known to be very rich in magnesium and proteins. And generally in the vegan industry, it will have a good market, and also it is for the people who suffer from gluten allergy. This product has a good traction. So, but currently the visibility is very poor for this product, while it has a very significant potential for linking it to landscape level restoration. So when you have a product which you know the properties, and also there is some price point is there in the e-commerce space, or even we can come up with that. Yeah.
So the positioning of such products is working when it is positioned as a nutraceutical.
Yeah.
Rather than a land restoration project. So you'll have to.
No. That is because we are basically concerned about how do you make restoration financially viable. That is the whole.
So restoration is a byproduct. that should be how it is seen. So you have to sell the story about this and a health story, and then do what you want to do, but storytelling has to be different. That is how it is. Yeah.
Okay, I got it.
Next up, we have some questions that have been raised by Arun Krishnan. Arun is from the WRI India team itself. He's a program director for climate finance. I'm going to read out the questions, Arun, but feel free to just
No, sorry,
Yeah.
Aprajita, maybe you can take my question last. Please let the participants first get their questions answered. Our champions. Manisha had her hand raised, and there are a few other questions as well.
Sure, Arun. We do have enough time. I want to assure you of that. But yeah, we'll prioritize the champions first. In the order that the questions were raised, I see that we had a question from Dr. Amrita on what patterns do you see among ventures that succeed after funding?
Okay, so being grounded is the key factor. After having raised funds, there's so much excitement and press releases and congratulatory messages, and then companies get into kind of a lull, and in the process also burn cash like there's no tomorrow. But those who have fundamental business sense and been able to, that is why when you raise funds, you should raise enough funds so that you don't need to raise funds again for the next 2 years, so that you can concentrate on doing your business. Because if you are just chasing fundraise after fundraise every 6 months, you really don't put your head down and do work. So those who have raised funds and devoted their time to business generally do well. And today, I think all investors are looking for profitability, unit economics, scalability of this business, as well as a continuous upgradation of technology, being up to the market. And then ultimately, when we get to the conventional, all startups at some point of time have to join the mainstream businesses. It becomes a relevance of market share and repeat customers. So if you're able to crack that, have a decent market share, and you have loyal customers, then you're made.
Yes, Amrita.
Thank you.
Thank you. From Abhishek from Navok, we have a question that is there a trend in agri-tech startups for moving into trading agri-commodities, moving with tech, and why so? There's also another question from Navok, Abhishek himself, that how to approach NABARD, and are there any schemes that help in selling manufacturing units? So two different questions.
Okay, so there's too much of a temptation to get into trading. Almost everyone does that. Initially, it looks attractive, but most of the time, it's a slippery ground. And one bad deal or one transaction where you make losses could finish your business. So almost everybody, to show growth, because you want to have a valuation which is a multiple of your top line, get into the trading business. It's not wrong, but often it has been the Waterloo for many agri-tech companies.
So, follow-up question onto that. Has it benefited people? Like, I've talked to some founders, like they say, okay, as you said, to improve their top line, but has it actually helped them, or like, how is it?
Uh, difficult to conclude. It's difficult to conclude basically because are you because you have the money, you can distort the market. You can pay more to the person from whom you're buying, but it's a temporary phenomena. So has it been on a sustainable basis? Is the question we have to ask. But these are all, I think, you have to apply uh, research rigor to statistical data, then only make conclusive statements. Otherwise, these are opinions of people like us.
The second part of the question that Abhishek raised was on NABARD schemes and how to approach them in setting manufacturing units.
Yeah, so I think the most popular or the most well-known is the AIF. And it is not a NABARD scheme, it is a Government of India scheme where a bank loan, uh, the interest can be subsidized as well as the loan component can be guaranteed through some guarantee mechanisms, including uh, CGT SME. So those are some mechanisms. Other than that, again, NABARD is an apex institution. It may have schemes, but these schemes are implemented through banks or other institutions. And if you go to the website, you will be able to get there are schemes, but I think these are just formulated by NABARD, implemented through lending institutions and others. If there's something specific, we can get in touch and find out. I'm an ex-NABARDian. I'm a director on NAB Kisan also. So to some extent, I can have access to information if your question is very specific. Yeah.
Okay, we
Sorry
will take
to
it up later.
jet in, but related question, sir. NABARD schemes can be accessed by private NBFCs also. Like, for example, Caspian that now I think it's called Black Soil. So
Hmm.
these people can also access the NABARD schemes.
Like which one? I think, for example, AIF is available only to banks and designated NBFCs, what they say. So NABKISAN as a NABARD subsidiary can get the benefit of it, but Black Soil may not be able to get. So the policy itself has to be read. Yeah, Arun, does that answer your question?
Yes, sir. Thank you.
Yeah. Dr. Manisha, over to you. After that, Amrita will take your question.
Hello, sir. Thank you for today's session. So, I'm Manisha and representing Openfield. We are basically building a community-linked forest economy infrastructure through NTFP processing, traceability, and market system. So, my question is, sir, how can we use existing partnership like community side of MOUs and institutional buyers as financing signals rather than just a relationship signals? That's something which I've recently come across it because since a larger part of our work creates public value, such as better livelihood, reduced loss, and moreover, like stronger standing forest incentive. What is the best way to
Mm.
present this without sounding like, grant dependent social enterprise?
Uh, I think building this narrative and getting public endorsements of these, it'll have to be built around communicating the benefits of these. Probably what I see that it's something that has a greater common good, as we were saying. and will not be easily appreciated or easily monetized as well. But if you can, look at it as, let's say, educating people about this, then it could work. So it's a longer term in terms of communication, buy-in from others, getting particularly, where are you operating in?
Currently in Chhattisgarh, sir, and bits and part of Jharkhand, and moving towards Maharashtra, sir.
Right. So local corporates or CSR,
Yes, sir. CSRs,
these
some
are
of
the
those.
guys, they want every year these companies want to show some new pictures in their CSR. So that is where the storytelling and all that will work. And a lot of it is about, as you're saying, not asking for money. Unfortunately, many times corporates and others are scared that these guys are out to get money. But if you can tell them that you're going to talk more about the good that it does rather than looking at their pockets, then it builds a story by itself. So building maybe on the social media, communicating, making some technical papers, putting it out in conferences, getting some professionals, your DFOs and others, the most difficult guys to talk about this. That will be the good thing.
Yeah. Over to you, Sai, and then we'll take your question, Dr. Amrita.
Yeah, hi sir. Yeah, I think we are building in that same carbon credit space, and today the only source of revenue, at least we are betting on, is carbon credits for now. Because for us it was more like as a small company, we can only focus on one particular thing, maybe make that SOP, all of that, right? That's what we are looking at. So in terms of investment, as of now, we have been grant driven largely, like
Right.
grant plus a little bit of angel, the angel investment. But now, if one we are thinking of like in terms of scale up right now, so which is that better sort of capital, because we have spoken to people at least in Indian ecosystem. So
Right.
yeah, the answer today is largely more on maybe will this market works, because the red flag is more on carbon dependent revenue. That's where the things are.
I know. Yeah, there's some people who have a great hype around this, a great potential, or let's say they see big money, and the others who are very critical about this space. So there are two extremes
Yeah.
of people around this, and there's been quite a bit of money flowing into this thing. Ultimately, I think what we are seeing is the farmers are saying that we have got nothing. We don't know what is happening, but a lot of things happening, but we have not got any benefit. So I don't know how that has to be resolved.
So is it debt? Is it even debt ready? Because the space right now, at least.
We have funded. Two projects for debt, but not greenfield projects. Mostly gap filling and other kinds of things. In one is in Meghalaya and another somewhere. But these are again backstopped by huge, what do you say, guarantees. So we have just taken the risk on the basis of guarantees that we have got. And the second is by buyers in Europe who have agreed to buy these things. And the reputation of those buyers is quite good. So the reputation of the intermediary and the buyer are good. Plus, we have a guarantee in place. So on all that basis, we have funded some projects like this.
Taking Dr. Amrita's question. So Dr. Amrita asked that for technology-driven diagnostic ventures, what is usually the most suitable financing pathway? Is it equity, venture debt, grants, or blended capital?
What business is this?
Dr. Amrita is from Arogyam, and they have soil diagnostic services that are there as part of the device that they made. Dr. Amrita, do you want to talk about your technology and your current model?
Yeah, we actually work in the area of agricultural traceability system.
Dr. Amrita,
We
could you
can't
be
hear.
louder? I can't
Yeah.
hear. Yeah,
Is it okay now?
perfect.
Yeah. So we are working in an agricultural traceability platform solution where there are multiple devices that are integrated with the platform. So one of them is soil and water testing platform. Then we have pesticide residue testing. So we have received some grants and then some seed funding. Now we are going for a scaling thing. So I just wanted to know which pathway we should mainly focus on. Is it equity or blended capital?
Blended, see, if you're going for debt, then blended finance de-risks you. See, the reason why we go for blended finance is because it takes the pressure of the entrepreneur. If an installment is delayed or if there's something, as a lender, we have a responsibility to start enforcing the legal clauses. But when you have a blended finance, you don't have the risk of the lender chasing you in such situations. That is the thing about blended finance. But the debt has to have those 2 or 3 rules that we put, which I think once Aparajita circulates, you can read again. Is there a steady cash flow? Is the customer paying for the service? Is the income that is earned enough to service the debt? All those check boxes have to be checked if you want to take a debt. And that you can do. If it blended finance, the cost of debt may come down. So you apply that number, whatever it is. Can you borrow at 6% and repay? It passes the test. Equity is something that gives you a long-term horizon. So basically, equity is non-returnable. If things don't work, the investor cannot come and say you return my money. So therefore, you get a much longer rope, a time to prove your business. So equity is always something which is a very long term. So if somebody is betting on you and your technology, take it. There's nothing like it. Take everything, whatever works. There's no this or that. But when you take debt, you check those whether you will be able to service your debt. Check it out.
Yeah. Okay, thank you. So we have already taken some debt and we have received it and we are repaying it now.
Okay. Okay.
Yeah. Yeah. Thank you. Thank you, sir.
Hitesh, do you want to come in?
Yeah. Hi, sir. So I'm from Grama Ventures. I think Jaspal has connected with you like 2, 3 times earlier also. So my question is, like we are working on the millet value chain, and now we have introduced like one more indigenous variety, Khapli wheat. So major business is B2B right now, but and some of the part like we are launching the D2C as well. So whenever we are going for a VC fund, we are going to any investor. So they say on the like gross margin of 12 to 13, 14%. Right now, we don't feel it is a VC investable model. But the same time, I see like the Krishna from the Pasiri Banta. So they are also into the Chilika B2B value chain, where they were able to raise the fund for that. So I just want to understand your perspective on this lines. If we are into the B2B, then how we should position
So,
ourselves. Yeah.
so has Krishna raised debt or equity?
Did mostly in some of the equity as well, angel rounds.
Angel rounds is of course it's more an individual decision. It's not an institutional. So margin, this is there are two simple things, margin and turnover, right? We have funded Krishnaya, that much I can say. So if the margin is maybe 10% and the debt is at 16%, how is he able to service a 16% debt? So it's a matter of rotating the money, that's all. Is he able to rotate it 4 or 5 times and then he can do it? So basically it is millets may have a longer cycle compared to this. So it's not that we have to see these both factors. And typically for debt, we look at a margin of 30%. That's something is a kind of a threshold. Less than that also we can do, but then other criteria. If it is 30 and more, then we can straight away say it's a debt fundable business.
Okay.
Thanks. If we have no more questions from the cohort members, Arun, do you want to come in with your questions? I could read them out, or you could raise them.
No, you go ahead and read them.
Okay. So from Arun, the first question that we have several questions. I can go one by one, Mr. Murray, or I could read them out all together and you could take them.
One by one, so that
Yeah.
otherwise
Okay. Okay.
memory you may not stay in my memory.
So the first one is, what's the incentive structure for a professional to represent a startup in negotiations?
Arun, can you clarify what you mean?
So, I mean, you mentioned about getting a very good professional when negotiating the term sheet and so on. So, how does a startup like the cohort which we have, right? How do they find such professionals? And what is the incentive for the professional as well, right? How much do they pay, etc.
Yeah, there are good professionals. Not necessary that these have to be marquee names, but these have to be people who protect your interests when they represent you in the negotiations. So that is more. You have these national law schools, many of them, and very competent professionals are there. So somebody who doesn't compromise or doesn't give away your interests in the process of negotiation should be the one who is. And I think the way we have been able to do this largely is to consult incubators and accelerators who have identified a pool of people and who they believe are good. And there are companies also who are specialized in legal consultancy to startups. So you can look those guys. What fees they charge, I have no idea, but I'm sure it won't be unreasonable. And what you can lose out by not, by yourself, doing it by yourself, you will lose for sure. So it's good to have somebody. The fees and other things I am not aware of, but they should be reasonable. They could be a
Charge equity
percentage
as
of,
fee.
could be a percentage of the transaction, and maybe, I don't know.
Okay. Fine, sir. Next question is, you had mentioned about cash flows. RBI had introduced Treads platform, right? So is that platform any use at all for smaller players, for SMEs, or I mean SME to SME or SME to large business? Because what I understand is that Treads platform has been used a lot by PSUs, but others I am not aware, right? So has this been, will it be useful to the cohort as well?
No idea. I have no idea on that, but I'm sure it will be. There is a clause in the company's declarations. If you read any company's financial statement, it will have to declare dues to MSMEs. How many dues are there and what is the time it is due. And these are taken very seriously. Whenever there has been a legal case filed by an MSME for non-payment of dues, it has always gone in favor of the MSMEs and money has been recovered in many cases in recent times. So the legal situation as of now is favoring small corporates who deal with larger corporates. So experience is that way. Exactly about threads, I don't know too much, but I think I'll find out also. But maybe or may not be, but I'll try and find out.
Thank you, sir. And the other one is credit guarantees you mentioned, right? So, in fact, in an earlier organization, I worked on a credit guarantee with Wilgrow as well. But the larger question is, has it become more challenging especially RBI has cracked down on the digital lending players, which is, the larger ecosystem has interpreted it as beyond digital lending, right? So, and also they have tightened norms on provisioning and all that. So, has credit guarantees become more difficult to implement?
See, there is one sector which is the financial services space, right? Microfinance, uh, digital lending. That's a space by itself which is prone to a lot of fraud and therefore has to be dealt with in a different manner. But we're talking about companies like these which are into tangible businesses. Credit guarantee has not been difficult at all. The kind of guarantees, especially in Caspian debt, for example, almost 90% of our portfolio is unsecured. A large part of it is underwritten by guarantees, both onshore and offshore. And we've never had any trouble invoking guarantees and recovering the money. And even where we have gone ahead and invoked guarantees, we have not stopped with taking legal recourse to get back our money and recover funds and return the guarantee money in case we recover it. So we should not confuse these two. The second space is a very, very murky, dirty space. We leave it to them to figure it out. But into tangible businesses like what we do, there has been no problem with guarantees.
Okay, thank you, sir.
Arun, I think you have one more question that you missed.
Oh, sorry. Okay, so you mentioned convertible notes as an investment equity investment mechanism.
So what we do in our country is optionally convertible debentures and compulsorily convertible debentures. Right? These are the two mechanisms. In an optionally convertible debenture, the investor has an option to decide.
I think Mr. Murray is facing a challenge with his internet. We'll just drop in a text and wait for him to rejoin. So I think this is the last question as well that we had from Arun. After Mr. Murray joins in and he's finished answering this question, we'll have a quick screenshot taken of the group for the comms post to follow, and then we'll proceed to our office hours if there are no further questions.
Aprajita, I have another question. I've dropped this in the chat just now. So maybe we'll also request Mr. Murray to answer this if he can.
Sure, then I'll just wait for him to come back. Hi, Mr. Murray. Can you hear us?
Okay, yeah. Can you hear me?
Yes, I think there was a connectivity
Okay.
issue.
No, this thing fell down. So yeah, we lost. So the debentures, what we do in India is convertible and non-convertible debentures. what would you say, compulsorily convertible and optionally convertible debentures. So at the option of the investor, he converts into equity, and in a compulsorily convertible debentures, he converts at a, there is no option not to convert, but the terms of conversion could be figured out. And it's basically to when you do not have the you do not wish to waste your time negotiating the value of the company. Either the company is too small or the round is too small for you to be able to come to an agreement on what is the value of that company. So therefore you leave it to the next round when there's a larger transaction and you get a discount on that and all that. Convertible notes, to my knowledge, is a very unique offshore product which American and other companies are investing into. I have no knowledge of that.
Okay, sir. Thank you.
Yeah, over to Divya's question. Divya is asking for the cohort sake that are there any insights on fundraising strategies for a Section 8 company?
Yes, so basically I'm asking this because I believe there are quite a few of our cohort enterprises, if I'm not wrong, with the Section 8 status. So if you can just share any insights, anything to keep in mind if you're a Section 8 company.
Yeah, a Section 8 company is not equity investable to my knowledge. So it cannot attract equity, especially of a commercial type. Right? So that is the current situation to my understanding. A large number of microfinance institutions were Section 8 companies at one point in time, and the Reserve Bank said that a not-for-profit cannot do a for-profit business, and therefore they had to migrate and become for-profit companies. So Section 8 has serious limitations on capital raise, profitability, distribution of profits, and taxability also. If it doesn't use the money within a reasonable time, it has to again pay tax. So therefore, Section 8 is a good thing, but to do commercial business, it is not a proper vehicle because of Indian laws and regulations. Almost every for-profit company on the side will have a not-for-profit entity for receiving grants and other things. So it's just a complicated legal landscape that requires one to have both entities.
Thank you. Thank you, sir. I'll maybe just quickly request if anyone in the cohort wants to ask any follow-up question on this. If you are a Section 8 company and if you have any other question on this or thoughts. Okay, I think if there are none, then back to you.
So there were a lot of complexities in even migrating from a Section 8 to a for-profit, where the accumulated profits can be given to another similar business, not-profit or whatever, but cannot be transferred to a not-for-profit. Some roundabout way, some legal and CS sat together and found mechanisms to do it in microfinance, but not the most efficient way.
Thank you. Thank you, sir. Rajita, back to you.
Thank you so much, Mr. Murray, for the session today. I think, Divya, if you could give us the closing notes before Mr. Murray leaves the session. Thank you so much for your time, Mr. Murray, and I think everyone had a really insightful session.
Yes, thank you. Thank you, Mr. Murray. I think this was a wonderful session, and I think especially because of a lot of practical insights, I think, which have been brought here from your experience. This has been very valuable. It's a great learning experience, even for us, the program staff of Land Accelerator. We have been sort of part of such capacity building sessions in the past as well. But I think every time there's something new to learn from you, which is very valuable. So thank you so much. And I mean, for those of you who don't know, Mr. Emmanuel has been a part of Land Accelerator for quite a few years now. He's been very gracious to sort of join us as the mentor, and as well as has also sort of shared his insights in these capacity building sessions. So yeah, I mean, it's wonderful to hear from you, Mr. Emmanuel. We'll also try and get in touch with you later in the the more advanced stages of the program, if you would also like to sort of participate and help us there.
Sure. So, just in conclusion, a lot of learnings that I share is a byproduct of the work that we do, and for greater good, I've put it out. Most of my work is out there for anyone to see, mostly on ResearchGate. So you'll find subjects like Water Users Association, Joint Forest Management, and things like that, which are related to what you guys are trying to do, producer companies. So you can read up on that, and we can also collaborate on jointly doing some more studies in the future. Yeah.
Payal will just be taking a picture. So if everybody could just please stay, Mr. Murray, we're going to be putting out a social media post on LinkedIn after the session with key insights.
Please
So
do. Yeah, go ahead. Yeah. Okay.
done. Thank you so much, Mr. Murray.
Thank you. Thank you. Yeah. Bye-bye.
Bye-bye. Great then. Okay, I hope everyone enjoyed the session today. Thank you so much for all your active participation.